And so for the last session of today, we're going to change it up a little bit, and we're going to go to a panel style formation. This panel is going to talk about adapting credit scoring models amid global uncertainty. To moderate this panel, I'm going to invite up to the stage Mr. Aldrich Antonio. Mr. Antonio has over 15 years of experience in risk management, audit, finance and financial strategy. He's currently working in one of the big four in a risk advisory capacity. And he's also previously worked for BNP Paribas as well, France's largest investment company. I'd like to invite Mr. Aldrich up to stage to head the next panel.
So thank you, Mark. Good afternoon, esteemed audience. My name is Aldrich, and I'll be moderating the panel discussion this afternoon. I think we have heard a great presentation from Melissa, Mark, Kwon Hao, and also Tommy. I think from Melissa, I just know that there is such a thing as a Golden Indonesia plans for 2045. It's really interesting. And thanks to Kwon Hao, I think I know why I keep losing my money in my portfolio of Bitcoin, Binomo, and robo trading. And also thanks to Pak Tommy, I think I realized I diversified by buying Pokemon cards. It's an alternative investment, and I think it works. Okay, so our topic for this panel today is adapting credit model amidst global uncertainty. And I will be starting by introducing our panelists. Okay, our first panelist is Joseph Sudibyo. He's a head of data scientist at Superbank. He leads the data science and analytics. Prior to joining Superbank, he was the head of data science at Ajaib, which means miracle. So we'll hear from him how his miracle in data scientists can help the bank in creating a credit model and credit scoring. The next panelist is Michael Sidartawan. He's a CRO of Aman and a book author. So Aman means safe. So he's also a great risk officer, chief risk officer, and he has a great experience in fintech space on how to create the credit models. Okay, and now we have the last panelist, Ms. Melody Surya Angwin. He's a risk advisory manager at a consulting firm. He has worked for a lot of companies, and her expertise is in the credit scoring process with tools such as SAS, SPSS, and Python. And probably before we start the discussion, I will start by saying that there's an old saying in a bank, right? That a bank lends money to those who don't need them, and don't lend money to those who actually need them. So this is actually a problem of credit models, right? Because actually with the right credit models, you can give the money to those who need them and they can pay them back. So now I think the credit model or credit scoring, credit rating is not just used by banks. It is used by other financial institutions and also corporations. So if you look at your inbox and spam mails, you know that they know you better than even your wife probably, because they have all your data and they can do the lending on your side. So I think we also see the trend in corporates. They use scoring or rating. They want to determine who can have receivables, who can have like a lending facilities. So therefore, credit models is not just for banks or financial institutions, but it can also be used for any corporates. But it's not all safe. It's not all good stories about credit lending or credit models, because the sting of global uncertainties are still with us. The scars of COVID is still with us. So what does this matter? Because it requires the push for more accurate credit models, more accurate credit ratings and scoring. And now we will hear from our distinguished panel, how can the credit models can help us navigate the uncertainties, the global geopolitics, or probably disasters, or even climate effects to our economy. Well, without further ado, I will start these discussions with Pak Michael. So, Pak Michael, can you help to enlighten us that amidst the global geopolitics and market conditions, can you share how fintechs in general develop and implement the credit models?
All right. So thank you, Pak. So hello everyone. My name is Michael. So I would say I have an experience of doing as a role as a CRO during the COVID-19 pandemic, right? So it is not an easy time, but it was an interesting time, right? Because you get the first-hand experience on how the market change, right? So maybe this is talking coming from experience. There's no right, there's no wrong. It's just that things that I think we observe in the market, right? That's an interesting learning on how we can bridge that for the ongoing, right? So I have an experience in several of the fintech companies, right? So as you know that fintech is a different kind of lending compared to, I would say, banks, right? Because their target usually serve the underbanked, right? Somebody who might not be able to get credits from the bank, then fintech can serve them. So a lot of things, I think. Well, I think focusing on the discussion, what has changed and what is the learning is that before COVID and after COVID, there's definitely things that is very different, I would say. So the first one that we notice is that whatever is there pre-COVID and whatever is there after COVID is actually still following the same principles, right? So meaning that there is always high-risk customers, there's always a low-risk customers, but the thing here is that the relative difference might not be that much change, but maybe the whole level of delinquency is increasing during the COVID, right? So meaning that if you have 100 customers, you can still identify these ones are lower risk, these ones are higher risk, but the absolute delinquency is actually increasing for almost everybody, right? So I think this, to me, it's very significant because it follows the principles that whatever that we learn in managing risk is actually still holds during the good times and during the not so good times, right? It's just that how we can try to spot the trend change, I would say, right? So if we are talking about modeling, if you are talking about the data, I think most of the people here should be familiar, especially if you guys coming from the data science background or work with data a lot, right? So the thing here is that in terms of modeling, it's actually evolving before COVID and after COVID. It's actually still evolving, but it still follows the basic principles that if you are getting the data from these customers, you just need to be sure that the data you gain is actually verified, right? Meaning that what I personally noticed before and after COVID is that when COVID comes, there's a lot of bad actors, meaning that somebody who wants to defraud financial institutions is increasing, right? So it's not that people suddenly turn bad. It's not like that, but it's just that the needs for credit, what we saw is actually increasing, and several of the fraud actors are actually catching up on gaming this opportunity, right? Because people get more desperate, they are getting harder to get credit. So they are offering this service more and more for people who needs this, that they are helping these people. If you want to be approved, you just need to do it like this. You just need to do it like that, right? So this is what I think the main difference is that during the crisis and before the crisis is that the profile has not changed, but the incoming mix of your portfolio could be a little bit different because of these actors, right? There are so many things which I don't think we can cover, right? Because it is a very interesting things, but these two are, I think, the most outstanding ones. If we want to manage the volatility, I think lesson for, let's say, another cycle, which I'm sure it will come, right? Because it's always a cycle. That for Indonesia, I think these are the two things that we can try to highlight during the next crisis.
Thanks, Michael. So what I think just to clarify you a bit. So what you think after COVID, there's a rise in delinquencies, there's a rise in fraud, and can you share with us what are the tips and tricks on managing all those all those issues?
Ah,
Are there
okay.
any changes in the models or something
Okay.
like that?
So what I think practically then, if it comes to how we try to mitigate the risk on both fraud and credit, is that especially on fraud, right, in the fintech space, how we can spot this kind of things is that we saw a pattern change, right? So if let's say I'm just taking a simplified example that if you have, let's say, an application that comes from iOS and Android, let's say 60-40, right? Then during that period of time, the Android incoming mix is actually increasing to about 70 or 80%, right? Only for those periods, especially 3 to 4 months during the height of the COVID, that then it's slowly, gradually coming down again. So that's only one of the example, right? So I think if you want to try to mitigate, to try to spot whether you are under an attack of fraud actors, it's you can try to see whether your incoming mix of portfolio of the application is actually changed a lot over a short period of time, right? I mean, it's a different with credit. If you saw a fraud pattern, it's usually spiking very fast in a very short of time, and then it will coming down very fast again, right? So it's just that you need to be aware to catch this and then react accordingly. While for the credit, it's usually take a longer time. But what we can see in the portfolio mix is that when the crisis comes, it's usually impacting their ability to pay, right? So meaning that they are still want to pay, but the amount that they are paying on average usually seen reduce over certain segments which is impacted, right? So if that trends is changed, not on a short period of time, but over a longer period of time, let's say 3 to 4 to 6 months, then that's definitely things to be worried, which you can see also in the score performance that it will start deteriorating over time. I think those are the lessons that we can try to be more aware.
Okay, so yeah, that's from Michael. From fintech perspective, I think there are some key points here. When you deal with some changes, with the volatile times, uncertain times, there might be some patterns that you can see. So Michael said some delinquencies rate are increasing, and the verifications is getting more complicated, issues on that, and the fraud is also increasing. So how, I think one important message from Michael is that you can look at the simpler patterns, or you can look at the more complex patterns. But if you look at the more complex patterns, it takes time, which is on the credit side. But there is also a way for you to notice that there is simpler patterns that you can identify. For example, it is something interesting because let's say like 40% from 60% Android and 40% iPhone. If it increases into 70-30, then there might be some spikes that shows some issues there. So yeah, thanks, Michael. So I will move to Pak Joseph. So Pak Joseph, I think from your background in digital banks are quite new in the industry, right? And while we know that to get data for credit models, you need a long amount of time. So in a digital bank space, how do you cope with that? How can you create a how can you create a credit models based on the limited amount of data in a digital bank?
Thank you for the question, Pak Aldrich. Hi, everyone. I'm Joseph. I'm a data scientist at Superbank. But for that question, actually, there is no one trick to do this if you don't have any data, right? I mean, at this point, even in my current digital bank where I work, we don't have any data points, right? And I think there are multiple ways to approach that, because traditionally, if you want to build a credit scoring model, you need to basically have data to train the model on. But at this point, and for similar companies at similar stage, I think the way we do this is usually with a combination of trial and error, and also like using the existing solutions that are already out there. For example, in terms of credit scoring itself, we have a credit bureau here in Indonesia called Slick by OJK. And then it's the equivalent of FDC or FinTech data center for FinTech. So basically this credit bureau contains all of the information that you need to evaluate the credit worthiness of a customer traditionally, meaning like, for example, if I have an auto loan, KPR, a house loan, and also like other type of loans, it should be contained inside this credit bureau. So there are a few vendors, and using this credit bureau data, you can actually evaluate the customers. It's not perfect because, for example, for Slick, currently only data from banks and multi-finance are included in there. Maybe some fintechs are also uploading to Slick, but it's the data points are limited, and also like there are delays, 1 month delay because bank has to report only at the end of the month. So using this, you can actually evaluate the credit worthiness of customers is first point, but then is it enough? Because what happens right now, like digital banks and fintechs are sometimes after the same customers. Like initially more traditional banks, they are after customers who have a long history of credit. But nowadays, a lot of the banks want to go to the underbanked segment, right? Which is those who maybe have an account, have a saving accounts, but they actually are not eligible for credit because the traditional way of doing credit evaluation, like you have to have a credit history first before you can get your first loan. But the emergence of alternative data sources, so things like Telco Score, all of the big 3 players in Indonesia like Telkomsel, XL, Indosat, all of them actually offers Telco Score. So they could actually evaluate your credit worthiness using your behavior with the network, meaning they are able to understand how you are spending with them. You know, what time do you make your calls? What type of websites or applications do you have on your phone? For example, if let's say in the particular month, a user is opening like 30 lending apps or 30 lending websites, then you have to be suspicious, right? Like, does this person, you know, is it worthy to give credit to this customer, to this type of customer? So usually digital banks and other fintechs actually also leverages this telco score as one of the way to evaluate before they can create their own model, because they don't have data at first. But in addition to the telco scores, I think a lot of companies, fintechs, digital banks are already using telco scores, credit bureau data. But what about things like e-commerce data? What if we can understand your behavior in Tokopedia, in Bukalapak, or in Shopee? Can we actually guess your income? Or maybe I'm not saying income, but your capacity to pay, like the way you spend, the categories of items that you buy. Like, do you buy only groceries? Do you buy expensive items? Actually, a lot of things are going into that currently, that we are trying, a lot of companies are trying to leverage this type of alternative data source in order to evaluate the credit worthiness of a borrower, basically, simply because the borrower is underserved or even unbanked, right? They don't have a bank, then how can you evaluate their history? Yeah, there are a lot more data points that we actually can explore. Like, for example, in addition to that, there has been research around like social media data. I have not seen successful use case on that, but things like, in addition to e-commerce, ride-hailing history, yeah, basically any transactions data, or even, for example, if you use your mobile wallet, right, to do transactions, we could actually get your, I mean, of course, with the customer consent, if you decided to share your statements, bank statements, or like maybe this e-wallet statements, we can actually build a model to categorize how you spend in this e-wallet, in this bank. From there, we know like what your cash flow is like, how big is your income, what are the things that you spend money on. For example, if you are spending money outside of Indonesia, then we might consider you a more affluent customer and things like that. Versus if your spending is only like, for example, groceries and things like that. Of course, there are limitations to this because currently, depending on the bank that you use, right? And depending on the customer consents, like a lot of customers actually don't want to share this type of data. So it's kind of hard also. But usually these are the things that we are doing, that we do before we have enough internal data to actually train the model on.
Okay, thanks, Joseph. So I think there's some interesting point because actually no data doesn't mean that you cannot create credit models. But what you need to do is look at what are the alternative data available, then you can build a model on that. But probably with the new law, it's going to be a bit more complicated, right?
Yeah, correct. Especially with the new law that is coming up, taking into effect next year, right? Around Q4, the UU PDP, or like the data privacy protection law. Like whenever we receive a data, or whenever we want to use the data for something, actually the customer must give their consent. And in addition to that, the consent need to be specific. Like, what is the purpose of the data? And what is even more complex is the customer needs to be able to withdraw their consent. So, like, for example, if there are cases like, pretend that we already received the customer data, they have consented, we have built a model around the customer data, but then suddenly the customer called the bank or the financial institution on, oh, I want to withdraw my consent to use like my Tokopedia data, my e-commerce data, or my bank statement. Then what will you do with the data that you have already collected? Like, how could you push the data within the time frame that the regulator needs you to delete those data or to stop using it? It's kind of tricky, and I believe like a lot of data professionals are trying to navigate the rules right now, because I think from a lot of data professional perspectives, the rules are quite strict,
Yeah.
I would say. Yeah.
Okay, thanks, Joseph. So yeah, I think you made some points, some important points about the data availability and also on the regulations on the data that you capture and what are the data that you use in the modeling. I think there's such a thing as a machine learning, but probably there will be a machine unlearning, because once you purge the data, you probably have to take it out as well.
Yeah.
And you remind me of my Tokopedia account. If those guys knows what I'm buying in Tokopedia, it's probably I need to be scared about it. Okay, thanks, Joseph. I think to Mel, I would like to know from the perspective of a bank, because banks are the pioneers in credit models. They have been using it probably for 20, 30 years. And with the problems that we had and with the global uncertainties, they are moving into a new generation models. There's one that we're familiar with. It is called EWS, Early Warning System. So can you inform us why are they going to that direction and how are they implementing the EWS in terms of the credit decisioning?
Okay, thank you, Aldrich, for the question. Hello, everyone. My name is Melody. So basically, maybe we all are having a banking account and then performing the transaction via the bank and things like that. Maybe we are quite similar with the retail transaction and things like that. But maybe on this term, on talking the EWS specifically on the wholesale banking, so maybe if we say like what already Joseph and Pak Michael said, it's more onto the retail thing, but maybe now we are coming to the non-retail one. It's quite limited on how we use the data basically. So if we're talking about the retail, you can say like using the e-commerce account, we can define their transaction pattern, and then using the maybe e-wallet, things like that, we can define a new data points that we can use to create a model. But in talking about the non-retail segment, it's quite limited. What we can get maybe like the financial statement from the wholesale debtors, and also now we are exploring the transaction data that coming from the specific bank, for example. So if we are talking about the EWS and now why we are moving towards to developing that kind of model is basically bank already have a credit rating or credit scoring model. most of the bank, I suppose, unless it's digital bank, maybe it's quite limited currently, but I suppose all of the banks already developed their credit scorecard or rating model. So what's differentiate between the credit scorecard or rating with the EWS? So maybe let's put it into this way. We already have a loan application, for example, to the bank, and then they decide our credit worthiness, right? From our characteristic, maybe demographic, what is our job, what is our salary. If we are talking about the person, maybe we are talking about a small company, for example, like how much income coming every month and what is your expense, things like that. We want to see how their profit and loss, and we want to see how much the volume of the transaction in the debit and the credit. And then we decide whether we want to grant the application to this debtor or not. That's showing like we can see the credit worthiness of this debtor, like what is the probability of default of this debtor, but we cannot see in the future, right? This EWS currently is combining both internal and external data. So it's not only taking into account your transaction data or your financial statement, but it also taking into account the external condition, for example, like the macroeconomics. So this model currently not only looking into the debtor perspective only, but also the external perspective. Like, for example, we probably having some crisis or maybe in the midst of inflation rises, things like that. It can also take into account into this EWS model. So in terms of the predictiveness, it's probably better than the credit scorecard, the usual credit scorecard or credit rating. And also the ability of this EWS model, it's also can predict whether in the next few months, this debtor will decrease in the credit quality, things like that. So it's quite giving new insights to the risk management, I would say.
Okay, thanks, Mel. I think it is something interesting points because credit models is being utilized by banks, by mature banks, to look into the future, right? So it's not just what is the rating, what is the score at this time, but what will be the rating, what will be the scoring 3 years from now, or 1 year from now, or 5 years from now. Now, when you look into something like that with a long period of time, how accurate is that? I mean, based on our experience, can you explain, is it 90% accurate or 70% accurate? Because it is, I would say, something that is not commonly done in the last 10 years, probably.
Yeah, I would suppose like if you are talking about the EWS, since it's incorporating a lot of data, right? A lot of data types from the customer itself, demographic, and also the financial statement, taking into account of the transaction also. I would say the accuracy ratio from the my experience is more or less 70% up. If you are talking about the usual credit rating or credit scoring, usually it's only like around 40% accuracy. So in terms of this EWS, even if you're looking at the longer term, it still can accurately predict because of that robust data points that we use in the developing the credit model itself.
Thanks, Mel. So if I can summarize what the banks are doing, the mature banks are doing at this time, based on the newer credit models, is that they utilize transaction data. I think this is because most of the financial data is only on annual basis or quarterly basis. So I think transaction data can do it in a more frequent basis. And the second thing is what we call as EWS, which is combining the internal data and also external data. This is the macroeconomics data.
Yeah, true.
And also probably in the stock market and all of that.
Yeah, it can, I mean, like currently we only limited onto the customer data, the demographic, and also the financial statement, and currently the macroeconomics. But again, I mean, like there are a lot of data that we can explore. For example, we can even use the e-commerce data or even the e-wallet data, telco score. It all can be incorporated into the credit model.
So basically, even banks are looking into new data, new alternatives data, to find out whether the person or the company can pay and willing to pay. I think there's a like a red line within all the fintechs and digital banks and mature banks, in that they would like to keep on improving their credit models. It is for the predictive power and also for determining who is the right person I can give my money to. Okay, thanks, Mel. I think there's one more interesting aspect that I think this is something that that you also said on the use of AI, right? AI is a big thing. Like, just put AI in your company's name and probably you'll make a lot of money. Now, I would like in the past, it's crypto, right? Crypto this, crypto that. Now AI this, AI that. So what I would like to know is that what is the impact of AI, especially in the credit models? Because AWS is using a system, right? So basically, it's just this short-term way from system into AI, right? So I think I would like to ask our panelists about the hot topic, AI, right? How do you think AI can really help the credit models to adapt to global uncertainties? Or perhaps AI is doing something simpler? It's like making all the analysts watching Netflix on the job and let AI do all of those things. Okay, maybe I'll ask Michael first. What do you think about it?
So I think it's an interesting question, right? I mean, if it's really can help us watching Netflix, I'll welcome it. Of course, will make my life easier, of course, right? But I think the reality is not as good as that, unfortunately, right? So, okay, again, this is speaking from experience, right? I mean, in the fintech space, there's a lot of dynamics happen, right? I would say, because fintech mostly usually online. So we are attracting customers from a very diverse profile. You can have anybody download the app and then just apply, right? Compared to the traditional way of doing an underwriting or applications, you go to a certain shopping malls and then you source people who come to that malls, which usually limited to a certain profile, right? If you go to the high-end malls, then most probably you'll get the high-end profiles. So with this kind of things and changing market conditions, there is almost impossible for a traditional way of doing modeling and analysis to keep up with the change, at least in the fintech space, right? Except maybe if you are doing a very specific sourcing to a certain partners, maybe the challenge is not as big, but it is big nevertheless, right? So this kind of things can be taken by an AI because the analysis, because you only have, I mean, going to the practical data thing, you only have, let's say, a certain customer profile with a different profile compared to the rest of your portfolio, but it just come with a very limited set of data, right? Meaning that there might be people interested in your product, but it's just that they are just start coming to apply for the loan from your side. So if we do it traditionally, it will be very hard to spot there's a profile change. But if you employ machine learning AI, then it can be more apparent because they can process multiple data points, right? That they can spot something is going on or something is not as per the average here, right? But again, it's always a check of mix and balance, I would say, because in order for this model to perform, then it follows the principles that if you have more data points, then it will perform better, right? Usually relevant data points, but practically, economically, you have more data points, then you have more costs because you have to engage multiple vendors, you have to keep the data, you have to whatever, right? So it's always be, I would say, check and balance. And I think we are at the just beginning of this journey, that whether AI can replace the job or whether AI can complement the job, I think it's still a question to be answered. But I'm more leaning towards that based on what we do currently. It's actually starting to complement with each other, at least in doing the job of managing risk.
Thanks, Michael. I think from what you said, I think you made some interesting points, which is it is quite difficult, especially in fintech, right? When the population's profile keeps on changing, if you have to do it manually, it will be might be some lags in the profile changes, and it is not really efficient to do that. But I think what Michael said is that AI essentially can help on the high frequencies, but less complex works. You still need to start with something. So this is probably what AI is capable of doing right now. So it is very helpful in fintech.
Yes,
Pak Michael. Okay. Thank you, Pak Michael. I would like to hear from Joseph, another perspective. So in terms of digital bank, right, the credit decisioning is probably not automated. Some has to pass some credit decisioning. And what do you think of the role of AI can help you in helping the credit decision? Because actually, Indra and I, we had a bit of research funds. We look at ChatGPT and we ask, what is the credit score of one of the companies in Indonesia? Actually, they says, I don't know. Actually, if they can say yes, then I don't know what I'm doing for the next 10 years. But thankfully, ChatGPT still say they don't know. Joseph, can you help us enlighten us?
Yeah, I think AI is a hot topic right currently, and it's quite new. So I actually agree with what Pak Michael said earlier. Currently, AI is sort of like complementing the things that we do, maybe helping in some sort, maybe acting as an assistance. And actually, one interesting point is AI is really good at detecting patterns, right? They can actually understand, even if we don't talk about the credit modeling use case, they can actually understand your sentence if you put slang words. If you don't use any proper vocab and grammar, they could understand that. So one use case maybe in credit risk, and there could be a lot of use cases like this. Basically, if you have something like, for example, like the high frequency use case, is actually a good use case. So things like the transaction analysis or the bank statement analysis, right? I think from different banks have different formats, and traditionally, you want to build when you want to build credit models from using this transaction or statements, you need to categorize the transaction, right? Like, is this like spending on food? Is this like cash flow that is income, your payroll coming in? But payroll from different companies, from different banks has different, I would say, like characteristics and wordings in the bank statement itself, right? And actually, we last time in the office, along with the ecosystem group, we had a hackathon, and actually Superbank did try this one use case, and AI could actually predict these patterns pretty well. So for example, Starbucks, sometimes it's written as STRBUCKS without the A, or maybe like in some bank statements, because it's too long, it's being cut off at the end. But AI could actually detect that Starbucks is actually like Starbucks is the company Starbucks, and then it's a food and beverages category. So prior to AI, right, doing all this, you need to do like manual mapping, a lot of those, because if you list like all of the restaurants in Indonesia, or even like how can you do that manually, right? And then to be able to categorize these things into like the right category, whether it's grocery, whether it's like high-end goods, whether it's a subscription, whether it's like a one-time purchase, it's essentially a really painful task. And with AI, you can actually try at home with your generic ChatGPT. If you don't mind sharing your, of course, bank statement data to ChatGPT, that's another story. But I've tried, like the team actually, we have tried uploading something like this, and actually we could get a pretty good result. We could, for example, let's say I spend, I don't know, 5 million in a month, then they could actually help me categorize, oh, 1 million is for food, 2 million is for this, your income is 3 million or something like that. So this is one way AI could actually help us in the credit modeling space, because then what you can do is from all of this, right, it could become features, like the category could become features, and those features you can fit into your model, because I think there is some sort of maybe like loose correlation with probably like income or whatnot, right? For example, if I'm spending 5 million a month on food, I must have an income category of this much maybe. And if I am spending, I don't know, like maybe 2 million on entertainment or cinema, then that sort of behavior, AI could actually help detect those kind of patterns. But at this point, it's only like generating new features for your credit models. It's not entirely replacing the credit models. So I guess this is one of the use cases. And actually, even before this session, I was looking through the web, but I don't see any AI that has been successfully, like real AI, used in credit modeling, like to replace the machine learning or even the scorecard way of doing the modeling yet. But again, as Pak Michael mentioned, this is still new. Everyone is still learning, and AI is still developing exponentially. So we don't know. In the future, it might change.
Thanks, Joseph. So in terms of the use case of AI in digital bank, it can be used, for example, to automate some processes, right? So maybe for all of you who work in banks or having to do manual works, is basically AI can help you to do the copy and paste for you. Because from my experience, I think most of the job is not exactly analyzing, but doing copy and paste. And I think AI can help you with that, right? And what you said was interesting because AI is not used to generate new features in the credit models, but only to support the existing model, right?
I think it could be used to generate new features, but what I was trying to say is it's not replacing the
not
credit
replacing.
model yet.
So it is more like adding new pattern.
Yeah, it's like
but
helping us build the credit model. I would
you need
say.
to start with a proper model, then AI can help you to refine that, right?
Correct. Yes.
Okay. Thanks, Joseph. So I think the last one to Melody, I think this is the problem because we heard like AI can do this, AI can do that, but there's an issue of agency when it comes to decision. Because what is automated is not a decision, basically, it's an algorithm. When it comes to the decision, sometimes you need an agency, which means a person who decides yes or no. And the role in the past coming from a risk analyst or risk officers or CRO. So with the growth of AI, what do you think will be the roles of risk or finance professional in the future? Will basically what I'm asking, are we still going to do our jobs? Or is it going to do our job for us now?
Okay, thank you, Aldri. So basically, I think at this rate, AI will not replace our job, so we can all be a little bit feel safe. But again, as Joseph say, AI is currently developing exponentially. So in the future, I'm not sure. But I suppose currently AI is supplementing the risk analyst or the risk officer to make a decision regarding our credit worthiness. What I'm saying is basically, maybe Joseph already talking about the bank statement analysis, for example. We also use the bank statement analysis currently. We built some model to help us check whether the small medium enterprise has a window dressing currently, or it's a really transaction happening over there. And I suppose it was performed manually by each of the officer in the in the bank, basically to deduct and see whether this is a real transaction or not. Is this a window dressing or not? And then the net amount of the bank statement analysis. And also each of the bank has their own format. So that's a challenge also. As we might know, if we have a lot of human intervention, probably there's some error also in the data. So what we are trying to reduce is basically the error in the data input for the bank statement. So currently, like the AI can help us perform that task automatically. So it will help the risk analyst or the risk officer to get more accurate data. And also it will help in the decision making currently. Yeah, I suppose that answer your question, Aldri.
Okay, thanks, Mel. So I think from Melody's perspective, is still AI at this time, still not clear what are their capabilities in the future. But right this time, they're more of supporting the role of risk officers or the roles of finance professionals. I think there's a point on the agency. Sometimes what we need is someone who takes responsibilities right now. I'm not sure if I wants to take responsibilities if something goes bad. I mean, who's saying, who make this decision? AI probably is not going to do well with the board of directors. What do you think about it now? Does it work that way? Does the agency issues is something that is that might not be solved by AI? Still need someone to make decisions, because actually in the business world, someone needs to take responsibility, right? Which something that probably AI cannot do. So do you have any comment on that?
Yeah, I suppose again, AI currently is only complementing on the decision making. So it's not making the decision for us, but the human itself, the risk analyst, the risk officer still needs to take responsibility on performing the decision. But what AI can do, can support, is basically giving some more accurate information, and also maybe more accurate, and also the speed of the AI works more better than the human itself. So more accurate with the speed also. And I suppose, yeah, we still need to perform manually on the decision making, but AI will support us better in performing the decision making itself.
Okay, thanks, Mel. I will recap a little bit before I will ask some questions through the floor. I think from the perspective of fintech, digital bank, and bank perspective, credit models are something that is being used on a daily basis, and the lack of data doesn't mean that you cannot create credit models. I think from Joseph, he said like you can look at alternative data. I think if you're corporate, you can also, if you want to create a model on your receivables, for example, you can also use the alternative data. It doesn't have to be credit data. I think from Michael's perspective as well, is the use of data in fintech is quite a lot. And it is interesting how patterns change can actually inform you what is changing, what are the frauds, what are the issues that you have in your portfolio. From Mel's perspective, models are not just used to reflect what is the current condition, but they can also use to predict what will be happening in the future. With the use of AWS early warning system, you can look at the future with a decent amount, or well, not decent, but with quite a good amount of accuracy, 70%. And from the perspective of AI, we still don't know at this time how far they can go. I think, but right now it's more of supporting role. And I think the role of risk and finance professionals are still safe at this time, because someone still wants our head, right? If something goes wrong. Okay, I think that's the recap from the discussion, and I would like to check the floors if you have any questions. Okay, so please go ahead, sir.
Hi, my name is Aryo from Heyoka. I would like to ask a question to Joseph, probably, or anyone could actually add things, I guess. But I would imagine that, you know, if you're a primary bank, meaning that bank is used as a bank to compile all the incomes, where your main income stream is going through that bank, then it would be way easier to actually predict credit scoring. But as a secondary bank, if that's even the right terms, not knowing the income stream of the main income stream of a client, how much disadvantage does this actually impose to the credit scoring system? I guess, like, you know, if I were like to change the question, it would be like, how much percentage is the primary banks, which I think would be like, I say the top 4 or 5 banks, be in an advantage as compared to other secondary banks? I would think like digital banks would rather be on that kind of segment. And secondly, I think, assuming that it does have a significant role, what is the top 3 predictor of default, or like for credit scoring for secondary banks, other than you know, obviously if we can't get the income, the salary, then what is the top other 3 indicators, or like metrics that you can actually use in order to be on par with those banks who have this data set, I would say?
Okay, I'll try to answer the first one. I think you are correct that in a way, if we don't have, like, if we are not a primary bank, or if the income does not go to the account that we manage, then it's hard to guess the customer's income, right? And it's actually quite important because one of the goal of the credit underwriting is actually to determine the credit limit, right? How much could we give you? Because of course, we will ask like your salary and things like that. But if you are only like writing 50 million, 30 million, how can we validate, right? And it's not often that customer wants to share their bank statement that has their real income, or even like their tax statement. So what we can do is actually, of course, we are at a slight disadvantage, but actually we could build like this sort of proxy income by using by using like their transactions data, like in e-commerce, in other platforms that maybe we have access to, in ride hailing, in e-wallet or something like that. It will not be income, but it's a proxy income. And even without this, there are currently like vendors, even like the telco vendors, like some of them actually offers income estimation. So the income will not be accurate, like say 10 million, but they offer estimation in the form of a range. So this type of vendors, we could actually use also to determine the income. But I guess, yeah, in a way, like during underwriting, this income is actually very, very important. Like you need to be able to know their capacity to pay, basically, in order to determine like the correct credit limit. But there are ways to do that even when you don't have the user real verified income, I would say. Yeah, and then maybe before we go to the second question, maybe Pak Michael or Bu Melody, you guys want to add? I'm sure fintech has a lot of experience in this as well.
Okay. So on the income, I think it's always classical question, right? When we underwrite somebody, that can you provide your proof of income? And when they provide it, we usually second guessing, is this the real one or not, right? Usually forgery is there, right? They are upping their incomes. So there's a lot of proxy, just like Pak Yosef saying that the proxy income or derivation of income usually is the favorite way to do it if we don't have the real data, right? So the e-commerce transactions, if you have access to that data, will be very good. Or let's say if you have access to, let's say, travel data of the person, usually a person is spending a certain percentage of their income to travel, right, on yearly basis. So we can derive also the income from that. And there's also usually in fintech, what we do is that since we are serving the underbanks, then we know that their income most probably will be below 10, right? Or maybe below 8, right? That's most probable. And depending on the profession that they have, usually we are starting small on the first loan, right? So give it a small loan, see in the shorter terms whether they can pay. It's not 1 month, because 1 month might not give you a correct predictor of the sustainability of payment. Usually, let's say 3 months, you give not so big of a loan, they can pay good, right? And then the second loan, you are trying to increase the limit by a certain percentage, let's say 25%, 30%, and then see how much fall off of that segment, right? Usually after 2 or 3 loans, if they are able to pay consistently without anything overdue, if there's no big events, usually you can be safe to say that their income at minimum is at that level, right? So there's also a way that we can try to leverage how we derive the income from that.
Yeah, a quick one from Mel. I think this one is from retail perspective. Do you have any opinion, probably from corporate or SME?
Yeah, I suppose we have leverage here, since usually the bank can ask you to provide the bank statement from the other bank. We can leverage from that. And yeah, I suppose in terms of defining like how much your income again, maybe this bank statement play a bigger part because I mean, like we can always window dress our transaction, right, to make our income seems bigger than it should. But again, with the help of AI, probably we can give the netting from what your income should be rather than the window dressing part.
Okay, thanks, Mel. Maybe a quick one from Joseph on the second question.
Oh yeah,
From
I
audience, yeah.
think in terms of the predictors, unfortunately, like the strongest predictor is usually like your credit bureau history data. Like if you have that, like your payment on time payment data, repayment data, that is usually like the strongest. But then transactions in the other platforms actually come close on the probably like second or third place. The rest is basically like your behavior data. Yeah, I would say that is usually the top three.
Okay, thanks, Joseph. I hope that answers your question.
Okay, my name is Lugas. I'm from BNI Ventures, and perhaps because the first question is too serious, perhaps I want to ask something that is more lighter, but more I think it's higher level question. I think you guys will also mention that AI and also the has given us an edge on modeling on how we manage the risk, credit risk, in particular that we discuss. One aspect that I want to ask is about that. Other than lighter human touch, how do you guys really manage your model risk? Because I think we will become more reliant to our models, right? Or how we train all the data. But as we know, the world's getting more complicated, the data getting more unstructured and so on. So how do you really manage that something has changed, something that haven't incorporated into your model or basically your model risk? I think I would stop with that. Thank you.
I think if I can summarize your question, how do you manage your model? How do you manage your models, right? How you manage your risk models? I think maybe to Mel first.
Yeah, okay. So if we're talking about the wholesale banking and then how we manage the model, bank currently are exploring on the model risk management. So this is like a platform when we can put all of the models that are currently available in the bank. And then also the validation that needs to be performed periodically. And it's being maintained in this framework of the MRM itself. So it will help the bank to see if they already capture all of the risks that available in their current model, or whether they need to add more or develop more credit model to support maybe their business or their marketing, things like that. But I suppose having this one platform to support all of the model validation from the model development, from the integration of the model itself, it will help the bank to see the bigger picture of the risk management for the bank itself. I suppose that's from my end, maybe from Joseph or Michael.
I think I can add a little bit. I think still the usual way of, I guess the normal way of looking at the model life cycle still applies. So we have validation, and then throughout the life cycle of the model, we also use a few metrics to monitor the model, right? To see whether like the distribution has changed, the performance has deteriorated or not. So things like this, I think still applies, I would say. So even like, for example, if we dabble with AI, right? We will not, let's say we can create a model using AI. We will not actually launch the model without like the proper guardrails in place, right? maybe combined with the credit policy as well. And also the way usually like we, I guess as data scientists, we launch model is usually we test the model first on a smaller subset of users or smaller segments and see if it works well, then we scale it out slowly. Hence that way, there is still a risk, but the risk is minimized or more limited, I would say.
I think it's very interesting question. But again, I think how I answer it is going back to the basic principles, right? But so I mean, the model, the concept of model itself is not something new, right? But how we build model with machine learning, AI, and the market condition change is totally different compared to what we used to do traditionally. Logistics regressions, now there's random forest and everything, right? And then XGBoost and everything. But I think the basic principle still holds. So I think there are a few things that usually comes to mind. One is that when we have a model, it is built very specifically for a certain purpose, right? I think what usually the pitfalls is once the credit modelers build it, the business guy is using it for everything, right? So it's built for certain purpose. Now it's used for everything, right? That's where the model will fall short. And then they will come back why your model doesn't work, right? So then it's always a classical questions, right? So I think it's important that when we build a model, it needs to be very clear on what purpose, what are the target markets, and what will be the appetite or expected outcome when the model is being built, right? So when there's a new business or when there's a new validations, then it is important to always adhere to the original purpose of why the model and how the model is built. Then that things need to have a discipline. I think monthly, quarterly, or whatever is needed, then it needs to follow the basic same principles, right? That will be the first part. The second part, I think, which is not equally not important, which is equally important, is that we'll need to be able to validate our data. It follows the principle of garbage in, garbage out, right? Because when the model is built, usually using machine learning or AI, there's thousands data points that it is consumed, right? Then it usually come up with the 20 or 30 of the determinant variables. Now, these variables, we just need to be sure that it's not easily manipulated, right? So if it is something that is declared, let's say, then it is very easy to be manipulated, right? But if it is a bureau data, it's still possible, but it might be very hard to manipulate, except if you are having very specific person that is trying to build credit history and then suddenly they want to cash out and gone, right? But that's usually a very small case, right? So I think data validation is also important, and how we validate this data is, I think, something that is usually still evolving because more data is consumed.
Okay. Thanks, Michael. Thank you for sounding all the concerns of risk modelers in the world. Okay, I hope that answered your question, Pak.
Thank you. My name is Restu and I come from telco company, Telkom Indonesia.
Okay.
Okay. I have two simple questions actually. The first one is, as per I know, the customer segment or customer profile of fintech or digital bank currently is including, sorry to say, maybe we can say like not the big fish one, because big fish maybe still in the conventional bank.
Okay.
So in a more business term or in the technical level, we talk about the credit worthiness, credit scoring, but in the business level, operational level, is there any contradiction or like a dispute when you make a decision, a business decision? For example, like as we know, like we can say that the customer of digital bank and fintech in Indonesia is the one maybe get difficulties in getting a loan or credit from the conventional bank. conventional bank. So how essential is you making a really good model of credit worthiness, credit scoring, if in the business level of decision making, there's a dispute or contradiction. For example, if the credit worthiness is, for one customer, if the credit scoring is low, but for business, how company will make profit if you really selective in making a customer profile? And then the second question maybe for Jacob, because we have the data for the mobile data consumption. So I want really know, or maybe you can explain in a brief about the model. For example, like how many is the weight for example, the mobile data consumption from your model to determine the credit scoring? Maybe you can say like 20% from the model, or what is the other 75%, for example, to determine the credit scoring? Okay, thank you.
So yeah, thank you. But I'll try to summarize and probably just give a quick answer, probably just 2 minutes. The first question is about the opposition between business and risk, and how do you as a risk officer or risk analyst is handling that? Well, that is probably 80% of the stress in risk management, right? So the second question, I think I'll give to Joseph on the percentage of telecommunication data usage.
Okay, so I think dispute will always be happening in a healthy business, right? If the risk guy and business guy goes along 100%, I very doubtful. They don't work, right? So I think it goes back to that basic principle of model development. At the very, usually when we build a model, there's a purpose, there's a goal, right? Usually it is to determine good and bad, right? Which is the bad usually is the loss, okay? But after that model development cycle, there's usually an additional step, which is what we are doing is that we are trying to see if we determine the cutoff of that score, how it will impact the revenue, right? Which might not goes along linearly with the loss, right? So I'm taking example of a certain very good portfolio, let's say risk level A. It is very good, 0.something% loss, but the revenue is so small, right? Because there's only the pricing is very low, that's attract that kind of customers, right? So that normalization, I think, will come to the sweet spot on what will be the loss and what will be the revenue that can pay for the loss. It goes back to that question of how the risk appetite is being set. I would say that's usually how it goes between risk and business, how to be solve the dispute.
Okay, so the answer is how you determine the risk appetite in the model development. I think the next question, Joseph.
On the second question, I actually probably don't have a very good answer for this, because currently, due to like some regulation and things related to regulation, I think most of the telco companies actually do not share the raw features itself. Meaning like the features that you mentioned, like data consumption, for example, it's they mentioned that they did use that, but if we the output that we receive is not like for example, for Joseph, do I spend 1 GB each month or something like that? But it's more like Joseph has a score of 700. But to build this 700, they actually do share the list of variables, and data consumption is one. And then the other one is like habitual variables, like how often do you open like e-commerce sites? How often do you open your mobile banking or lending sites, or even like travel websites? And then another one is basically like the monetary variables, like the pulsa that you buy, the data package that you buy. But other than that, the data variables that you mentioned actually falls under usage. So they actually look at like phone calls, WhatsApp, SMS, not the content, but more on like usage, what time, how many, and things like that. Yeah.
Okay. So yeah, thank you for questions. I think we have a lot of questions coming in. So, we'll kind of talk about it later during the dinner after this. So thank you so much for the enthusiasm. There's a lot of questions. There's a lot of interactive activities. But I think that's all the time that we have for this panel discussion. So I would like to thank all the panelists. Let's give them a round of applause for all the panelists.